A lot of focus on this non-farm payrolls report, as we do every month here, but will it really have any impact on the Fed's rate hike timeline? Are they so focused on specifically inflation?
I think will have some impact. They've very clearly said that they are going to monitor every form of data, and the only real strength that's been coming through, bar housing, which is starting to tail off a little bit with the weather changing, has been employment growth, and that has been fantastic for them. Now, of course, they haven't had any wage inflation, so that's why it's not knocking through to really pushing them forward. And I don't think the Fed's going to hike the rest of this year. Certainly not going to hike in March anyway. And the Fed are already telling us that effectively between the lines, that they're being quite cautious about global events, and they don't want to scare the market, is what Mester said yesterday. It was a very interesting point, I thought, from her. So, I mean, in essence, the payroll number is going to be seen as the only one strong thing we've got through. And we've seen both the ISM services number coming weaker, and obviously the manufacturing's been in contraction now for 4 months. So manufacturing is basically in recession, and now the services sector, which has been a real strength, is starting to taper off. So employment remains the lone sort of bright spot, really, and I think at some stage we're going to see a correction that lower. It may not be this month, but December was a shock for a lot of people. It was a very strong number that may well have taken a lot of the gains which we're going to see possibly in the January number. So I wouldn't be surprised if, I've already seen the estimates falling from around 200 down to about 185. I think it could be a slightly weaker number.
You say the Fed doesn't want to scare anybody given what's going on in the marketplace, the global volatile equity space and the oil space as well. But then again, we heard from Esther George saying this is really not a surprise. And she sounded much more hawkish, saying, look, we are still trying to hike gradually here.
I hugely respect Esther George. She's one of the most sanguine people on there, but no one is listening to her, and no one's going to listen. She's not in control of this. And you listen to people like Stanley Fisher and one or two other people who are sort of, should we say, more swing members on the FOMC. They are clearly telling us that they're stepping back and they're going to watch and wait here. Now we'll find, of course, from the most important person, Yellen, next week, and she'll be telling the Congress exactly what she thinks on. And I would expect her to echo pretty much what Stanley Fisher said.
Well, certainly when you look at the U.S. Treasury market, of course, this does not suggest that investors here see 4 rate hikes going into this year at all. And really, you have to wonder, given that the Bank of Japan has now entered the negative interest rate environment, are investors simply being driven into Treasuries because they are desperate to find yield somewhere?
Well, Treasuries are actually the big underperformer. If you look at where, 10-year JGB yields at 1 basis point. Really, it's quite ridiculous. And we've seen where bunds have gone, and we've seen obviously where gilts in particular have moved the last week or so. The treasuries are actually lagging, but the 5-year has done extremely well. It's up, down some 50 basis points in yield in the last, basically this year. So the money's coming into the mid part of the curve, but the longer end is still struggling a bit.
And what do you make of the move we've seen into gold here? Is this sustainable?
Yes, very much so. I think gold is a very logical place of investment to be. And you notice China, which we're talking about FX reserves and what have you, but their actual purchase of gold are on the increase again.